the New York Fed. Here with more on the wallet shift for consumers is VantageScore CEO and President Silvio Tavares. Silvio, it is good to see you. So always look to you, Silvio, for a read on the consumer. You know, we are in earnings season. We heard from the big banks. Of course, big tech is on deck. But interested to get your perspective, Silvio. You have access to that credit data. When you're looking through that, what do you see? How healthy, how strong does the consumer look to you right now?
Well, the consumer looks healthy, but the reality is there's definitely risk on the horizon. Both banks see it and consumers see it. According to our monthly VantageScore CreditGauge indicator, banks actually throttled back on new credit accounts in the most recent period in September across every major loan category: credit cards, auto loans, personal loans, every category, banks cut back. And consumers really see risk as well on the horizon. They're cutting back. For example, if you compare September credit card balances to August credit card balances, in September, they actually decreased slightly. And part of this is just the upcoming election. Consumers are uncertain about what's going to happen next. And banks are also uncertain about what's going to happen next, and they see risk on the horizon. The two presidential candidates have very different economic policy agendas. And so basically, both are basically taking a pause.
You know, when we talk about the consumer, Silvio, you know, obviously it's not one consumer. There's many kinds of consumers, you know, low income, middle income, high income. What kind of differences are you seeing?
Well, you know, that term we all learned during the pandemic, that K-shaped recovery, well, that's definitely made a comeback. If you look at the experience of millennials, older affluent consumers, they're doing just fine. In fact, you could see that in the monthly credit gauge. The average overall consumer credit score is 702. 300 is the worst score. 850 is a perfect score. And so overall, you see the average consumer credit health remaining pretty healthy through September, mostly driven by those older consumers, those born after 1965, what we call X. Now, on the other hand, younger, less affluent consumers, they are actually struggling. And in fact, they're continuing to struggle even more in the most recent period. We saw delinquencies across all credit products really increasing for those younger, less affluent consumers. And really what's driving a lot of that difference in experience is whether you're a homeowner or not. If you're older, you own your own home, you've got a cushion there, you're not exposed to inflationary pressures. Younger folks are not homeowners typically, and they are struggling with the increased interest rates and the very high rate of inflation that we've seen over the last 24 months.
You know, Silvio, the Fed already cut once, delivered that outsized cut. We have any number of strategists. Had one very smart strategist today on the show who said, you know, listen, they continue to believe they're going to keep cutting because inflation just is not where Jay Powell wants it to be. How much of a tailwind potentially is that for consumers, including the consumers you're highlighting as facing more challenges?
Well, it's definitely a tailwind, but the reality is it does take some time to hit. And we saw that in the September numbers, right? September was when we saw the Fed cut rates. And we had expected some more lending or a pickup in lending and actually, quite frankly, an increase in demand among consumers. But actually, that didn't happen. And so that's quite notable. So I think the Fed is going to look at this data and they're going to really have to think about whether they do a more aggressive rate cutting. But the reality is there's some challenges with cutting rates too aggressively. You don't want to be in a position where you reignite inflation. So definitely a balancing act. But I think if you look at just the way consumers are using credit, there are some warning signs there, some flashing signs, particularly on the credit card front.
Having said that, Silvio, you know, holidays fast approaching. What would be your guess about consumer spending during this holiday season? You think they spend, even if they have to take on more debt to do so?
Well, I think there's definitely a desire to spend more, but I think a lot rests on how this election plays out. If you look at the data for the most recent period in September, credit cards in particular are flashing a lot of warning signs. Delinquencies were up across all products. Delinquencies were up on a 30 to 60, 90 and longer basis, really across every vintage of loans and age of delinquencies. Everything is flashing red. So I think consumers do want to spend more, but the reality is they're uncertain about how the election is going to play out. And depending on how that election plays out, especially the presidential election, that's going to have an impact on consumers' willingness to spend more. So the bottom line is it's uncertain. That's how consumers see it. That's how banks see it. As we get closer to the election and after the election, we're going to be able to give you some more insight on what's going to shape out for the balance of the holiday spending season.
Silvio, always great to see you and have you on the show. Thanks for joining us.
Thanks for having me on, Josh.
Dow drops 300.